Imagine two friends living in the same city. On exactly the same day, they both receive an unexpected windfall, $100,000 in cash. The first friend takes their money straight to a traditional bank. They deposit the entire amount into a savings account. It's a move made for peace of mind. The money is safe, accessible, and insured. The second friend takes a different route. Instead of keeping the cash, they immediately exchange the full amount for a variety of productive assets. Fast forward 10 years. Both friends have left their money completely alone. Who ends up wealthier? And what specific forces created the gap between them? For the first friend, that bank account offers a sense of total security. Logging in and seeing a six-figure balance feels responsible. The vault is secure, and the numbers on the screen never go down. But there is a constant pressure acting on that currency. While the friend sleeps and works, the broader economy is moving. The very nature of a fiat currency means that as more money enters the system, the value of every existing dollar is stretched thinner. Think about the cost of your daily life a decade ago. A basic trip to the grocery store or a simple cup of coffee cost a fraction of what you pay today. The items haven't changed. The dollars used to buy them have simply lost their edge. This split chart reveals the reality. The flat line represents the $100,000 balance, never dropping a cent. But the shrinking bars below show the buying power of those dollars in a steady decline. Keeping money completely still isn't a form of safety. It is a mathematical process that results in a slow, predictable loss of wealth. This brings us back to the second friend. They traded their cash for productive assets. A productive asset is simply something you own designed to generate income or grow in value. Usually, this involves four categories: ownership in companies through stocks, real estate to rent, bonds as interest-bearing loans, or direct business ownership. These function differently than a stack of paper bills. A rental property collects monthly checks. A healthy company generates profits and pays dividends. These are structures built specifically to produce new value over time. The wealthy prioritize these over cash because they recognize that owning things that produce income is a primary way to stay ahead of rising costs. By holding these assets, the second friend benefits from compound growth. This is the engine that drives their portfolio forward. The math is simple. The initial investment generates earnings. If those earnings are reinvested, they begin generating their own earnings. Time acts as the catalyst. Growth looks modest in the first few years, but as the timeline scrubs toward year 5, the geometry multiplies at a higher frequency. The longer the cycle continues, the more the numbers accelerate. This process replaces a stagnant pool of cash with a system that creates more of itself. It turns the money into a workforce that grows through its own momentum. But around year 5, a sudden market crash hits the economy. The second friend's portfolio value drops significantly. This is the reality of investing. It involves periods of decline and the emotional stress of seeing your net worth fall. However, they protected themselves through diversification. By spreading their money across different types of assets, a crash in one area didn't mean total loss. Their real estate might hold steady while their stocks fall, or their bonds might provide a cushion. Volatility is the price of admission for long-term growth. To avoid all risk is to also avoid the rewards that compounding provides. We finally reach the 10-year mark. We can now see the results of these two different paths. The first friend still has exactly $100,000, but the cost of a home, healthcare, and education has climbed. Their safe choice resulted in a lifestyle that is now much harder to afford. The second friend experienced the crash, but they also captured 5 additional years of growth. Their wealth has multiplied. By owning assets, they didn't just keep up with the economy, they participated in its growth. The ultimate strategy isn't about holding zero cash, it's about balance. Most people need a reserve of cash for emergencies to ensure they aren't forced to sell their assets during a crash. But for the long term, the assets do the heavy lifting. Money sitting still slowly loses its power. Money invested wisely has the chance to grow. If credit cards are so convenient, why do banks make billions from them every year? That's our next documentary.